Okay, well, this is a nice segue actually into your pro picks because I believe 3 of the 6 past ideas have been taken out. ProPicks is brought to you by ATB Financial. With over $100 billion in assets, ATB Financial is powering possibilities for more than 843,000 financial services clients. ATB Cormark Capital Markets is a leading North American investment firm providing holistic corporate and capital markets advice and full-service financial solutions. Visit atb.com/inthemoney for more information. Okay, so because you've been on twice, we have 6 ideas to kind of compare. You were on in January of last year and May 1st of last year, and 3 of the names have been taken out. Varen, upside 17%, taken out. Meg Energy, upside 30%, taken out. And again, your prices might be different, but this is just from when you recommended it. And New Vista, taken out.
I'm sad.
And I feel like you don't like that.
I don't.
Tell me why.
We're in it for the long game. Like you've had close to meet on. We've disagreed over this. Like I don't want to trip over pennies on my way to dollars. And I'm not buying companies with issues that need to be fixed. And if people were just to be a little more patient, I think we would have made significantly more. Like imagine Meg today in a standalone basis at $75 WTI and $12, $13 WCA diffs at a time when there's scarcity for long life reserves. Where would that stock be? It'd be way more than what Cenovus has performed. So it's an example where I'm not hoping for any of my names to be taken out. In fact, I don't want them to be. I want my investors are very patient. I'm very patient. I want to let the thesis play out.
Your remaining 3, Athabasca, Expand Energy, and ARC Resources. Athabasca we're going to talk about because you've brought it to us as a top idea once again. ARC, you've already said you've moved on because of their Attache woes. Expand, I think a lot of people have questions about that. That one's about flat from when you talked about it in May. Do you continue to like it? Has the thesis played out? Is it slower than you expected?
It's the largest natural gas producer in North America. What was different to us is they jettisoned their CEO. In fact, I met the interim CEO yesterday. So he was in Toronto. So the core thesis has not changed. But when you don't have a permanent CEO, it's difficult to attract capital because investors say, well, okay, we'll just wait for the new guy, which is going to take 4, 5, 6 months and see what he has to say. So it's probably not a name that we would be deploying new capital in, especially.
You're hanging on?
We're not. Yeah, we're more biased towards oil than we are natural gas.
Okay. So with that in mind, you've brought us 3 oil plays. Whitecap is one of them. And we actually got a lot of questions in the mailbag about Whitecap. So talk to me about your thesis here. Again, you only own 10 stocks right now?
Right now, yes.
Right now. So that means that you really had to scrutinize these names for them to qualify in the portfolio. Why did Whitecap make the cut?
Yeah, it remains our largest holding right now. It's built roughly 11.5% weight in the fund. And it checks off every box. You have a CEO who's been in the game for a long time. I would expect him to retire in a couple of years. Honestly, he's done a great job. He's very reliable. They've beaten, I think, for like 16 quarters or something in a row. It's ridiculous. They stole Varen from us at a great price for them. They've got 25 plus years of stay flat, tier 1, super high quality inventory. They've got a market cap that is big enough to be relevant to institutional investors. I'm going to use my cheat sheet here, but like $16.5 billion market cap, that's big enough for anybody to want to buy. And yet it trades at a discount to their larger peers. Like we would have it about 5.5 times, where you're paying closer to 8.
Why does it trade at a discount?
Well, it takes time. It takes people are so slow. Like I find generally, like we're pretty fast, but it just takes people, they need to meet them multiple times and get bullish on energy and get bullish on oil and okay, we'll dip our toe. It just takes time.
Move beyond C&Q and Suncor. Oh my God,
yeah. Maybe we'll take on some risk and we'll get out of C&Q a little and dip our toe. And so you don't need much though for these names to re-rate. So for us, if I'm paying 5.5 times, that'd be using 65. So it's closer to where we trade now at 75. It's trading at 4 times. Well, okay, we're not going to use current spot for that. But we're bullish on oil the next several years. So what we have a stock where, let's use 70, look at a year from now, and this is contingent on multiple re-rate. on them continuing to execute, continuing to drill amazing wells, no more M&A, all these different things. A 7 multiple for us at $70 oil is a $20.54 target price. That's 51% upside. And we're significantly more bullish on oil over the next several years. Because again, demand's growing, supply is not. Oil has to respond high enough to incentivize high-risk offshore exploration and development. That's not happening at 60. It's not happening at 70. I don't even know if it happens at 80.
And at a time where we were talking about expensive stocks in the energy sector, you're looking at Whitecap and saying it's trading at a discount.
Very.
Despite good execution.
And it's only up 19% this year, and it's lagging others. So I've got everything I need in a name trading at a discount to its peers, pays a 5.4% dividend. It's got a great balance sheet. Every single box I need to check off, it has.
Okay, so that brings us to Athabasca, which has actually been, a home run for you. It's up 64% from when you last recommended it. We actually got a question about this too from Michael on X, who wanted to know about the potential for a dividend. Talk to us about Athabasca. Do you think a dividend at all is possible for this?
I don't think it's their highest priority. You've got a massive reserve base, which I think they want to grow into a very bullish backdrop eventually once the oil price is higher sustainably to justify it. So it's a name where it's an interesting example. If you looked at you pull up a stock graph, you'd be like, oh my, we got to sell this thing, right?
Because it's so beautiful.
It's done so well. It's spectacular. It's like it should be in the Louvre. It's unbelievable. But it's a name where, because of the gift that so many of these Canadians have, such deep reserves, it's really important to look out beyond the here now over the next couple of years to see, okay, well, what could it be trading at in 2 years, 3 years, 4 years from now? Because that's really, one, it will give you staying power to sit on your hands and not take short-term gains, and you'll realize a lot more of the win. So for this name, just keeping production flat, the oil price flat at $70 oil, so a discount to where we trade today, well below what I think is the marginal cost of supply, just through modest growth and ongoing share buybacks, they'll compress their multiple from about 7.5 times today to about 5 in about 3 years' time. So it's a name where you don't need the oil price to continue to go up for a company like this to do very, very well.
It's one of those names I said that, there's a bunch of downgrades in the sector. Most of them are valuation.
Sure.
Athabasca got a downgrade at the end of February. Love the company, growth prospects, everything's awesome. Price target goes up.
Sure.
But it got downgraded on valuation. What do you say to that?
I don't listen. We have our own price targets. I never listen to Bay Street analysts, and they're all good people, but their priority number one is job preservation. And many of them have been far too bearish on the sector and far too bearish on the oil price. And a lot of them just use strip. So it's like, okay, strip falls and then strip's 57, therefore it's a sell. Well, you got to have a call on the commodity to begin with. You've got to have a call on looking beyond the next 6 months, look out to realize the full potential in a name like this. We've ridden this name from 17 cents. We would have been in and out a couple times, but we've gone from 17 cents to $9. If I had listened to Bay Street analysts from that time, we would have sold many, 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 many dollars ago.
Is it?
In fact, when I bought it, it was probably a sell at the time.
Yeah, universally rated a sell. Yeah. Is it I know you don't like takeouts, but it's a small size. It's doing well. Do you think it's on the radar of other producers?
I think if I'm directionally accurate in the world that we're heading into, there is going to be a crunch, and the strategic value of long-dated reserves is going to go up meaningfully. And so we're aggregating resource now in anticipation of that coming I'm not going to give a timeline, but in the future, because we have to be positioned for that. And so there's names where I just want to sit on my hands and not sell anymore, despite short-term runs. Maybe we get a 5% check back. Great, big deal. This is one of those names. This, Strathcona, a couple others, where I think the strategic value of what they own is going to be resultant in a meaningfully higher share price, or we wake up to what we've done with Varen and Nuvista and Meg, et cetera, where if the market doesn't realize it, then an acquirer, especially at a time when booked reserves globally are at their lowest levels in history, literally, at a time when oil demand is at its highest point in history, at a time when non-OPEC production is peaking, at a time when OPEC spare capacity is near a record low. So that's the world that we see. And I don't think we're going to be alone in a year or 2 or 3 years' time in recognizing the strategic value of long-dated reserves.
You said you have a price target. Can you tell me what it is? Higher. I thought I could peg you down on that.
Just sit on your hands and let the thesis play out.
Okay. Your third one is Ovintiv, the former Encana. God, all these name changes. What do you do with
This
them?
is a horrible name too.
Horrible name.
Yeah, horrible.
Did I even say it right? Ovintiv. For a while, I wasn't even saying it right.
Yeah.
The former Encana, did you come through it purchased New Vista, which you own? Did you come to the name through your ownership of New Vista?
No, we bought it fresh.
Okay.
So we had sold New Vista. We wanted to squeeze more upside out, and we was trading what we thought was fair value relative to the bid. We've bought Ovintiv, and it is a new name for us, but it's big weight. It's 9%. We're up 23, 24% on it so far. And the thesis is you've always had this stock that is a hedge fund hotel. It's always like high beta. You've got the knife fighters in the U.S. hedge funds, trading it around the quarter. Will they hit their quarter will they miss by a penny, beat by a penny? And that's not our game. We're in it to buy a company that has repositioned their portfolio. They were all in these disparate areas. Now they're in 2. They're in the Permian and they're in the Montney. And they've got really good positions in each. So they've cleaned that up. And in doing so, I think they're becoming more institutionally palatable to get better investors into it and ultimately result in multiple expansion because there's no knocks anymore. And they just sold off their last non-core area, paid down debt, and got to a point where they're now going to be returning at least 75% of free cash flow back in the form of share buybacks. That's critical. We've really done well in identifying companies that have just reached that threshold, and it's the buybacks can really propel the share price up, and it's starting to do that now. So we look at a company where they'd say they have, at least 20 years of drilling inventory in the Montney. We would say at least 15 in the Permian. So that's quite good. Maybe they even sell the Permian one day and come back to the pure Montney. And let's run with $65 oil. They're trading at 5 times cash flow. So significant discount.
Yeah.
And from a free cash flow perspective this year, we'd have it at about a 10, 11% free cash flow yield. So, you put a 6 multiple, run with $70 oil, well, that's 50% upside. And this is a name, again, where every year you're going to get that cumulative impact of share buybacks where they can buy back 10% of their stock
and you think
year
they've
after year.
Cleaned up? They're not as disorganized as they were?
No, all of these skeletons in the closet we think have been revealed. All of the historical knocks against it have been revealed. And I really had to get my head around, okay, is this a value trap hedge fund hotel stock, or does it have the potential to morph into something else, something new? And that's kind of where we've gravitated towards. And the stock's telling us so far that we're right.
Eric, it's been an absolute pleasure. Thank you so much for joining us.
My pleasure.